Joining us right now is former Fed Vice Chairman Rich Clarida. He served as Assistant Treasury Secretary in the George W. Bush administration. He is now Global Economic Advisor at PIMCO. And Rich, thank you for being with us.
Glad to be here. Yeah.
So Rick said a little while ago he's glad he's not in the Fed today, having to make this decision in the FOMC. What about you?
Well, what I'll say is I think it is a close call. The PIMCO calls it a close call, 25, 50, 75, or 100 for the rest of the year. I think the big picture, though, Becky, is the Powell Fed thinks that rates are restrictive. They want to do everything they can to support maximum employment. And so they're going to be projecting and talking about a lot of rate cuts over the next 12 months. Whether or not they ratify market pricing, which is very aggressive, is to be seen. But we're sticking with our call of 25 today, really based upon the post-Jackson Hole macro data, which, as you pointed out today, has been pretty strong, and commentary from Fed officials before the blackout.
Yeah, I mean, that to me would be, the idea if you're going to go 50 basis points, that usually happens when there is some sort of an emergency or we feel like we're really behind the curve. The data doesn't really back that up.
Well, what history tells us that story. The last two times the Fed cut 50 for the first cut was in 2000, before what became 2001, before what became a brief recession, and September of 07, and we know how that ended up. So, yeah, typically when the first move is 25, it's not been right in front of a downturn.
Right. Where do you think the economy really is headed? How do you what are your directional pointings?
Well, the direction is that it has been very resilient for now going on 2 years. I mean, Atlanta Fed keeps revising up his GDP tracker. We do think eventually that the economy does drift down towards trend growth, around 2%, maybe a bit less. I remind you, we've had a lot of good news on inflation in the last 3 or 4 months, but on a year-over-year basis, the Fed will probably project today inflation running at 2.8 or 2.9, and so there's still a ways to go on disinflation.
Yeah, that's a long way to go from 2%. Yeah. We've heard others like Jamie Dimon bring up the idea that if you think this inflation issue is cured, you should maybe take a few steps back. It sounds like you're echoing some of those concerns.
Sure, the progress has been remarkable, and certainly I think it does make sense to begin to remove some restrictive policy. Yes, the real funds rate is elevated, but financial conditions have been easy, and since the Fed signals these cuts, they've eased a lot in the last 2 months.
Steve?
Yeah, Rich, I've got only 100 questions. I'll keep it down to 2, though.
Okay, hi, Steve.
How are you? What is the thing that you would, from a risk management standpoint, which maybe you translate it to human terms and say, what would you regret most not having done? If you get a weaker jobs report, are you going to be hitting yourself on the head for not having done 50? Or if you get a stronger inflation report, you're going to be hitting yourself for having done 50. Where does the risk management fall out here in your mind?
Well, Steve, right now, I think that because of the lags in monetary policy, regardless of what the Fed does today or really did in July, the near-term employment numbers we're going to get are basically what we were going to get. So the Fed needs to be setting rates today based upon where it thinks inflation and the labor market's going to be in 6 to 12 months. And so I'm not really all that sympathetic to, behind the curve July versus September. As I said, really since April, financial conditions have eased materially. Bond yields are down 100 basis points. You talk about those mortgage rates, auto loans. And so as we've seen in the past, the bond market will do the Fed's job for it and will begin to front run those cuts. So I really don't think about it really so much as a risk management exercise in 25 versus 50 today.
Rich, just following up, and if we could get a camera on Joe, because he'll almost certainly yawn when I ask this question, but we don't talk about the balance sheet. It's a $7 trillion balance sheet. When I looked at, there he is. Somebody hit him. Wake him up. Wake him up. It's a $7 trillion balance sheet. When I looked earlier today at different monetary policy regimes out there, we've done 4.8 average since 1960. We were 0.8 during the from the great financial crisis to the pandemic. None of those seem to work because in that time we didn't have all that stimulus from the balance sheet. How would you as a policymaker think about what kind of stimulus is still coming from a $7 trillion balance sheet?
Well, I think everyone agrees, I think including at the Fed, that they hold a lot of treasuries and mortgages, and that is putting downward pressure on yields. What we don't agree on is how big that effect is. I welcome the fact that it looks like QT will continue, even though today they're going to cut rates. When I was there in 2019, we more or less ended QT at the meeting in which we cut in July of 2019. So I think that the balance sheet, from my perspective, can continue to get smaller. And in particular, now that the Fed has this new facility to support the repo markets, I would hope it would continue. But in terms of measuring that effect, it is difficult to do.
Hey, Rich, let's talk about another balance sheet. So that's the U.S. government's balance sheet. Front page of the Wall Street Journal today is about how both our presidential candidates are talking about spending increases, tax cuts, that is going to make it an even more difficult proposition. I mean, the Fed is there to be making sure that it's watching one side of the balance on the sheet on this. The federal government does the rest. How much harder does it make the Federal Reserve's job when this is happening? Do you worry about rates kind of getting out of control and the Fed not having as much control over things because of these huge concerns?
So Becky, you're absolutely right. It's really mission critical, and there are really two parts to it. The one is that big budget deficits, and the CBO numbers are really depressing. Regardless of roughly what happens in November, the baseline projections are 6% budget deficits as far as the eye can see. So that obviously makes the Fed's job harder because it supports aggregate demand. On the other hand, we've got 100% of GDP of debt outstanding, $30 trillion of treasuries. You were kind enough to mention my time at the Treasury 20 years ago. In those days, treasuries outstanding were about 40% of GDP. So now it's 100. And if anything, that tends to put upward pressure on bond yields because people have to be compensated to hold all those treasuries.
Right, so you can try and lower rates, but good luck selling it.
So absolutely. So big budget deficits and big stock of debt does complicate the Fed's job. Now, they have the ability to offset it, but it is an input into their assessment.